So I'm going to talk a little bit about kind of what's going on in Washington today regulatorily, and then I'm going to talk about why we think oil prices will be materially higher in the back half of the year. I'm just going to hit on a couple highlights. So what did I say last year? I said regulatory versus legislative, that Congress wouldn't pass anything. We were wrong. Congress passed a material piece of legislation effectively allowing crude oil exports, right? That was a big win for the industry. We might have given up too much for that. That's another issue. It's not going to have any results because production's falling. We'll talk about that. But over the long term, that's going to be a big deal, right? There's no immediate impact, and that's good because the last thing you want to do is allow U.S. oil exports and then see a spike in price, and then you have some issues. So we think the executive branch, at least until President Obama's out of office, will continue to push initiatives via regulation, and it's things like the Endangered Species Act, where you can regulatorily block just about anything. So those are the things to watch. The question is, that's through the end of 2016. What happens beyond that? I have absolutely no idea, right? It's above my pay grade. So that's something for smarter guys here to talk about. So I want to demystify a couple things, right? You'll hear people say oil's $30 and demand is weak. This time last year, we're all worried about Greece and the impact on oil demand. Well, Greece is, in my supply and demand model, Greece is only slightly more important than Rhode Island, right? It didn't matter. Global demand last year was fantastic. So let's put some numbers on paper. This is global oil demand growth annually since 1987. Global demand's fallen 2 years, 2008 and 2009. So if you think we're going to have another 2008, 2009, global demand's going to contract, oil's going to be 30 for another 18 months. Look at what happened in 2010. Global demand grew at 3.5%. All of that demand growth or contraction was a coiled spring. We got it all back and then some. Demand in 2010 was higher than demand in 2007, right? Look what happened in 2015. Demand growth grew 1.8 million barrels a day, or almost 2%. That's outstanding, right? 1 million barrels a day is a mid-cycle, I think, consensus in our mid-cycle demand growth outlook. That's what we're forecasting effectively for 2016 and 17, right? Betting against demand is hard. A smart guy said, so a guy who's a very successful investor said, bears sound smart and bulls make money. What he means by that is you can create a really smart-sounding bearish argument, but if you're going to bet against demand, it better be dang accurate, okay? So the other part here that's interesting, there's a lot of variability year to year. 1 year's demand you can't forecast demand from 1 year to the next, right? If I have good demand 1 year, it doesn't mean it's going to be that good the next, or if it's soft 1 year, it doesn't mean it'll be soft the next. So the point is demand almost always grows, and that's all we need for oil to get better. We just need demand not to contract. The other thing you'll hear is, why is shale production so resilient? I was at CERAWeek a few weeks ago, and that was the general consensus, right? So what you have to be careful about is the low price sets the narrative, right? Well, oil's low, therefore demand must be weak. Price is low, therefore production must be resilient. This time last year, the argument was oil production in the U.S. won't fall. It will be just like natural gas. When rig count fell in natural gas, production didn't fall. It kept growing because we had the Marcellus and the Utica in the Northeast. And I know this because I spent 3 months on the phone this time last year, and the only thing we talked about was why U.S. production was going to fall, and people just didn't believe it. So U.S. production is not resilient. This is onshore U.S. production. Look at that growth. That growth was phenomenal. It isn't phenomenal anymore, right? If you trend line so onshore U.S. oil production peaked in March. It's been falling at 65,000 barrels a day per month since then. If it trend lines, and we think it'll actually accelerate declines because of activity, but if you just trend line that number from March of 15 to December of this year, we'll have 1.5 million barrels a day of production decline, right? That's a lot of things. Resilient doesn't fit, right? Demand is good. U.S. production's falling, and by the way, the rest of non-OPEC is going to fall, and that's not in the talk, but PetroChina's production is going to be down this year for the first time since 1998. So why is oil still 30? Okay, so this is OPEC. That's the wild card. Let's think about this. We have two. I break OPEC into two buckets. I look at second-tier OPEC, which is the bottom curve, and that's on a structural decline that was really established in a much higher oil price environment. That's Venezuela, it's Nigeria, it's those sorts of countries. They're declining at 200,000 barrels a day per year. That decline will accelerate in a lower oil price environment. The top graph is the aggregate of kind of volatile and big OPEC. It's Saudi, Iran, Iraq, and Libya. You've got a lot of volatility in there because of sanctions and geopolitical unrest. What's interesting, the growth in that curve is what we missed. It wasn't that demand was soft. It wasn't that U.S. production wasn't falling. It's that Saudi and Iraq increased production 1.5 million barrels a day over about a 5-month period. And it started about this time last year, right? That's what the market missed. It's certainly what we missed, right? And that is a big deal. Now, going forward, the question then is, why is the market so scared of Iran? Because Iran said they have 1 million barrels a day of production capacity. My wife might tell you we're going to retire to the south of France. Neither of those two statements is remotely possible, right? So, but that's what the market's scared about, because Iraq and Saudi added a bunch of oil. Well, my gosh, here comes Iran with another million. So let's put Iran in perspective. Iran was in pre-sanctions. They were on a fairly well-established decline trend, again, established during a much higher oil price environment. You had a million barrels a day or so of production off due to sanctions, but if you forecast that production decline to present, that's how we get to the 500,000 barrels a day of capacity that Iran has. Right? I think the move from 30 to 40, we've had an oil price recently, is the fact that in a post-sanctions world, you haven't seen 1 million barrels a day from Iran. I think that's why oil price is up, because that fear factor just went away, right? We think Iran on a net basis will be less than 500,000 barrels a day, because in this graph, you have some leakage over into Iraq, and that's coming to the market. So that leaves us to be a little bit fearful of China, but if we can get kind of comfortable around global demand, we know supply is falling in the U.S. We know OPEC's not going to grow a whole lot more. It certainly won't repeat last year. You can actually start to think that the market's much closer to being imbalanced, and that's how you get to $80 a barrel by the end of the year, right? And if this was an E&P audience, you'd hear a big amen to that. And I know that that's hard to believe that oil could be 80, but I am telling you, as a fighting Texas Aggie, anything is possible, all right? So with that, I'm going to turn it over to Matt to talk about oil service. Yeah.
Okay.